It's Thursday, April 22nd, 2021, and today we're talking about Clearbanc evolves into a double unicorn named Clearco. Axonify trains a U.S. private equity firm to invest in them. Absorb Software is absorbed by another U.S. private equity firm for over 500 million US. And pay attention to these payment players, MazumaGo and Plooto. Let's get started. First up, Clearbanc evolves into a double unicorn named Clearco. Clearco founders Michelle and Andrew are huge promoters of the Canada tech ecosystem, and they have been part of the TechTO community since 2013. Michelle will be joining us again to share her story, her insights, and her advice on starting and scaling a business at our interactive TechTO live stream on May 17th. Alex, they're always making news, but what's making news this week?
This is more traditional news making. They just announced $100 million USD Series C, valuing the company at close to $2 billion. They also raised $250 million in debt to deploy. So the headline here is, I think, their valuation, the amount they've raised, and it's sort of the evolution of where they were going, because they're no longer Clearbanc, they're Clearco, with a focus no longer just on financing, but also on providing guidance and advice.
So let's focus on that evolution. Actually start me with what they're doing today, and then let's work backwards. What does Clearco do now?
Okay, so you can break it down into two buckets. They have capital and lending products, and they have services. So if you look at the capital and lending products, they have two related products and a third one which aren't different, which is a bit different. So one is Clear Capital, which is the one most people associate with them. Hey, you're an e-commerce company, you need money to grow, you need money for inventory. That's Clear Capital. You're not that established. Your metrics aren't that as big. You got Clear Angel, which is smaller loans and a bit more guidance. And then if you're a SaaS business and you want to change that, MRR to AR, they have Clear Runway. So these are the products people associate with them. Then there's a couple of services which they've now broken out as products. One's what they call Clear Insights. This is basically a tool so that you can benchmark yourself on 20 KPIs against other companies in your industry. Clear Valuation, so a tool that estimates the value of your business, and Clear Partners, which I call a marketplace that helps you connect with industry-leading agencies, platforms, and services. So if you look at that, well, I don't know if you want to get into it, but it's interesting how these all fit together and what this says about the future of their business model.
Right, and obviously master class in branding with the Clear appended to or prepended to everything that they do. Now, work me backwards, because it wasn't always these types of services they were offering. You talked about the evolution. How did it start, and how's it going today?
So, and I also like to talk about the future. Look, I don't know if you can remember way back. If we had a Wayback Machine, I could show it to you on this. The initial site, they were focusing on providing loans to Uber and Lyft drivers. So they started out there, then they went from that. The next evolution was loans to Airbnb hosts, and then they hit on the e-commerce. Let's try lending against e-commerce players, and then they got product market fit. We can, if you want to break down why the Uber, Lyft, and Airbnb didn't work, we could discuss that. What do you think, Jason?
No, let's talk about the future instead. I like that way.
So they got product market fit with what they call Clear Capital now, which is, hey, you plug into our system, you show us your revenue, you show us your customer acquisition, you show us the margins, we'll lend against you and take money from your revenue. So it was a very great way, non-dilutive way to lend to e-commerce companies. Mm-hmm. And they kept expanding lending. Well, when you build a lending business is great, but highly competitive. You're convincing people to take your money. So the way to win that is either offer better product and service. So that means lend faster with less or lend with more loose terms, or have better financing. So it's a very competitive space. So my guess is there's probably margin compression issues or worries over the long run, and it's very transactional. If one day if I'm lending to you at 6% interest rate and someone's lending to me 5.9%, I may lose that business. So you get these services they offer, which provide advice and goes from being a transaction to a relationship. So hey, the idea with Clear Valuations, you plug in there and they say your business is worth, I don't know, 20 million, but if you improve your margins, improve your retention, it's going to be worth 30 million. So now all of a sudden there's an additional service being provided, which makes the capital less price sensitive, less transactional. And then if you look at what Clear Partners does is, hey, if you improve retention, you will be worth $10 million more. And here's our retention partners. And that's another way, just like Credit Karma will introduce you to credit card players. There's probably there's probably some revenue compensation or marketing fee those partners pay to be, those qualified partners pay to be in that marketplace. So you've gone from a pure transaction business to one where you're trying to build a relationship, you're trying to get away from price competition, and you're trying to build an ongoing relationship and find different ways to monetize that customer.
And they've announced a huge round today. Do the numbers back up what the announcement is?
Well, the numbers I see seem pretty nice. 4,600 plus companies funded, $2 billion of financing out there. If you do back of the envelope, TechCrunch breaks this down in their analysis of the round. They estimate that Clearco did 60 million in revenue last year. So 60 million revenue, close to 2 billion valuation. Is that cheap? Probably not. Is that fair? That's where the market is. And look, this company seems to have product market fit, seems to be growing extremely fast. If you go back through all the announcements, the amount they plan to deploy every 12 months increases significantly. So, it seems like this is a company to bet on.
That's great. If only, Alex, you had made that bet early. Oh.
Yeah. If I only started writing angel checks a year earlier.
Amazing. So now tell me about that path. Sometimes it seems, we talked a little bit about the ups and downs there, where they started and where they are today. For people who are out there and they are thinking about their own path to becoming a unicorn or a double unicorn like Clearco today, what do you think we learn from this story?
Well, first I'd say, and I'll get this will be a takeaway, tenacity and persistence pays off. The longer you're alive, the longer your company's alive, the more chance you have of finding product market fit. And I'd argue that Andrew Michel had the right vision. That the economy was changing. Not enough people are getting the capital they need in the form of loans versus equity to grow their business. Mm-hmm. It's their focus of who that customer has changed. And they went from the initial two, the thing Airbnb, Uber, and Lyft all have in common is you're dealing with platforms that have control of access to their data, that if they looked at monetizing, they can compete with you. And I'd argue that probably Uber and Lyft, the drivers churn quite often. Airbnb less so, but you're relying on one touch point for access to data. And they found, hey, DTC was growing quickly, and they pivoted into that now, SaaS as well. And these are people that need loans, but there's no platform you're dealing with. So I think these are people building companies that want to grow. So you go from consumers to businesses, churn dropped, the choke points dropped, and the vision stayed the same. The economy's changing, people need new access to capital. But it took them a while to get there.
I think it's also a major kudos and shout out to the leadership of this company in order to, of course, raise these incredible financing rounds and have partners that can believe in them through the pivot. So that these are very smart operators. They're understanding the business, making a bet. And when they see it not working out, making that pivot and, to steer a ship and to pivot a ship that's raised significant capital from big investors and to turn it into a win is a really, really hard thing to do. So always got to tip our hats to Michelle and Andrew, who have been leading this. What a bet on two incredible people and what they've created.
One more thing about that path before we get to the takeaways. So we talked about getting to product market fit, post product market fit. These guys Andrew and Michelle have grown this company extremely quickly, from customers to employees. And most people think once you hit product market fit, it's easy. Well, but your employees change as your company scales because people have different desires and skill sets. And anything that was an edge case 3 months ago is no longer an edge case. So the amount of constant reinvention and the amount of communication founders have to do to grow a company this fast without riding off the cliff is incredibly hard, and it's impressive what they've done.
Okay, so then give me your takeaways for the TechTO community. What's on your mind?
The valuation and scale of Clearco shows that it's possible to compete against large incumbents in Silicon Valley startups. Like they're competing against Shopify and Stripe and financial institutions. The talent, what it shows here is the talent, ambition, and capital is available to Canadian companies. And I don't know if that was true 10 years ago, but here's a company that is shooting for the Mars and will at least get to the moon. If I need to talk about fintech one more week in a row, I wouldn't be surprised. It seems like all we talk about is fintech. But fintech, it's funny. Fintech gets a lot of attention. It's getting lots of valuation, but this also where they're going with their business model shows that just providing money alone is not a profitable, maybe not be profitable. So I think every non-financial startup is going to offer financial services, and every financial, fintech company will start offering services other than pure capital.
Mhm.
So for founders, I think this is good news and a potential challenge. On the positive side, Clearco, as it scales, will provide another source of capital and guidance to a lot of startups and help them up. On the flip side,
Yeah.
it's going to be tough to get talent. It's tough right now. Clearco has to hire 300 more people this year. That's 300 more people going to compete against with someone that's well-funded. And like I said before, tenacity and perseverance wins.
Yeah, I think this is also great for the culture of the tech ecosystem because, throughout the career, those are leaders that have encouraged people on their team to take the entrepreneurial leap, to build something that's valuable and meaningful and think big. And I think we're also going to see a lot of people who have been part of the Clearco story continue to start companies. I know you know already a few off the top of your head, Alex, and I can imagine there's a whole new class of entrepreneurs that will be emerging out of this success as well.
For Andrew and Michelle, I hope those people be entrepreneurs for a couple of years so they can scale up and get to the point where the company needs to be. But
yeah, of course. But Alex, the type of person that you need at each level of your startup changes, right? And some of those people that joined early and helped get to that stage might not be the same people that you need now. And so they got to retool the army. I want to see some of those more entrepreneurs emerge, but I hear you. Talent is the name of the game now. Alex, is there a place that you can tap in to amazing talent opportunities, say every single Wednesday?
Yeah, our newsletter on Wednesdays Careers. We highlight a few great career opportunities, and rocket ship starts to join. We also give you career advice about switching to becoming a founder. Newsletter is a place to be. Wednesdays Careers. Friday is news in the ecosystem. You can get a verbal. We'll get one of our quick takes will be written up. We'll have a preview of another cool company in the ecosystem, and must-read articles from last week. To learn about what's going on and to learn about how to build a business.
So can you give us a sneak peek of tomorrow's issue? What can we expect?
Well, tomorrow I'm trying something new. I'm going to give profiles of the founders and funding guests we'll have on tomorrow's live stream. So you're going to have a bit of a background on Kevin and Andre. And Andre is impressive. He was the first 25 people at a company called Uber and another one called Hired. And he's not your typical VC.
Amazing. We're going to get into the live stream soon, but now we've got to talk about Axonify trains a U.S. private equity firm, Luminate, to invest in them. Alex, you always get to name drop your fellow Wharton alum, so I'm going to give a shout out to my fellow University of New Brunswick alum, Andrea Curry, the SVP of product at Axonify, who presented at our TechTO event in Waterloo in 2017 about why creativity needs crazy people. And Alex, it looks like crazy is paying off now, right?
Yes, it is. Waterloo-based Axonify just had a nice investment to actually take out previous investors and to provide capital to acquire other additional companies. So news here is Axonify, which is a training platform for frontline workers, had Luminate Capital Partners invest, I think it was $250 million to buy out GMI Equity, Harmony Partners, and BDC Capital, valuing the company about 3 times where it was in 2016, which was the last round. And Luminate said they've reserved capital to help Axonify complete acquisitions. So it seems like a win-win-win.
Amazing. And so tell us a little bit more about Axonify's business and maybe some of the growth that's got it to 3 times where it was at the last round.
Okay, so first, what they do is they fit in this group of companies called learning management systems. So these are software that helps basically train employees by providing the administrative tools, the tracking, the reporting, and the ability to deliver content. And it's a busy space. There's probably like 350, 400 companies that I could think of if I would, that are LMSs. What makes Axonify unique or positions it really well is they focus on frontline workers. So you can see lots of these other LMS focus on students or people in offices where you have software designed for me in front of my laptop. A frontline worker needs to get her information delivered to her in a different way. And so Axonify is focused on that, and it's paid off. They have 225 customers, including like Walmart, Levi's, and Bloomingdale's. Their annualized revenue rate is 35 million USD, and they have 215 employees according to LinkedIn.
So Alex, you're in the industry. You see deals all day long, every day. How and why does a deal like this come together?
Well, in this deal, there's three parties that have to agree to make this deal happen. There's the sellers of equity, because it wasn't the company. There's the buyer of the equity, and then there's the actual company that has to approve to change their shareholders, because I'm sure it's a private company. They have some right of who owns a piece of the company.
Carol's pretty savvy. I'm sure she wants to make sure that the right people are helping her succeed.
Yeah, so yeah, I'm sure she does. So let's start with her. So why would Axonify let someone trade out of their company? Well, you got a partner here who's explicitly said, we want you to continue to grow via acquisition, and we'll provide you capital for that. So here's a partner aligned with you. They say, and they're going to provide capital. It's one partner versus three. Not that the other three partners were difficult to deal with, but it's less stakeholders, has an upside and downside. If they buy into what you're doing, it's easier to move. If they don't, it's a bit harder. The flip side is why would a PE firm buy at this point? They saw, Axonify's claim they want to be, stated is out there saying we want to be 100 million USD revenue within 5 years. We want to do this via organic growth and acquisitions. They seem to have good margins because they've been capital efficient. They've only raised 22 million to get to 35 million revenue. So from a PE perspective, Luminate saw, hey, someone that wants to basically triple their size, needs money for acquisitions, has decent margins, can be leveraged up. This is a good investment. And for the investors they bought out, they tripled their money in, I don't know, 4 or 5 years, which is good return. They probably were leveraged up there, so they probably had a great IRR. Time to return money to their investors and find another investment.
I like that. And so if you're part of the TechTO community, why do you care about this deal? What gets you excited?
Well, first, fintech was the previous trend. The trend here is if you got a 15 million plus company, it's tech startup, and I don't have one, but I'm sure a few people do. And you're growing. The PE is looking Canada. Since this April 1st, there's been at least four PE investments in Canada of over $100 million.
In the tech space.
In the tech space,
yeah.
Right? So you're running a capital efficient company. It's growing. Mm-hmm. There's a partner there that wasn't there before. I think second, and more importantly, in my opinion, is Carol and Axonify are community leaders in the Waterloo area. They've shown their ability to execute and scale them, and it's a much needed win for the Waterloo community. Waterloo and community tech get a lot of love. There's a lot of talent there. There's been historically a lot of interesting companies, but truth be told, it's been a hard few years. The companies that were sort of the world beaters getting all the attention have basically evaporated. So Kik and North, one time future unicorns, world beaters, have been sold for pennies on the dollar. Yeah. So seeing a win like this for Waterloo is so needed and great. And then like Lupio last week, who raised money from private equity, an enterprise SaaS business can grow in a very capital efficient way. And it's going to be more efficient if we go back to Clearco. Like you now have opportunities like Clear Runway, which can give you debt instead of equity, which lets you be even more capital efficient. So, the power of enterprise SaaS business, you don't have to be targeting a unicorn's business to grow a big and valuable business. So
yeah, I love that. I think venture capital used to be the alternative form of financing that was the last resort for growing a business. And now look at all the alternatives for financing from Clearco, from old as new again, private equity, from all sorts of different sources. I think that's fantastic. Alex, if you want to join a community of Canadian tech founders, entrepreneurs, and investors, where do you need to go?
Costa Rica.
Oh, Costa Rica is a great place. I'm sure the weather is nice. Maybe their vaccine rollout is a little bit more robust than ours. But I was thinking something different. I was thinking the TechTO Insider Program. All right. That's where you get the knowledge, the network, and inspiration to help you thrive. Whether you're a current founder, a future founder, an entrepreneur, if you're mentors, if you're new to Canada or just want to break into tech, you got to head over to techto.org/membership. Alex, who have you met recently in the insider community?
Well, we had a few people join us from one of the Google accelerators. So there's Jesse Abrams of HomeWise, and Sarah from Felix, and quite a few more. Jesse's Toronto-based. He's trying to reinvent how people get residential mortgages. Another fintech play. Super nice guy, down to earth, and just understands customer development and seems to be building a big company.
Amazing. Next up. Absorbed Software is absorbed by another U.S. private equity firm, Welsh, Carson, Anderson, and Stowe, for over $500 million US. What's happening here, Alex?
So we'll contrast this to Axonify. So first, instead of being Waterloo based, this is Calgary based. So different city. It's
Otherwise, it's still private equity and it's still LMS.
Yeah, it's LMS. It's a bigger purchase price, is 500 million. But what's interesting is the majority holder here was another private equity firm. So you still got skin in the game by the founding team and some of the employees. But this was a trade from Silversmith Capital Partners to Welsh, Carson, Anderson, and Stowe, which sounds more like a legal firm than the PE firm.
So tell us a little bit about Absorb's size. So they're out in Calgary, not a lot, and it's B2B, so not a lot of people thinking about Absorb on a day-to-day basis across the country. So tell us, give us a little sense of the size.
Well, 1,400 organizations with 23 million users in 34 countries is their customer base, wow. 50 million USD ARR, and they had raised 59 million from the last private equity holder. And they have 300 employees going to 400 to 450. So, it's a sizable company that, to be honest, I hadn't heard much of before this announcement.
That's very cool. And again, you see these deals all the time. Is this coming together for a similar reason as the Axonify deal, or do you think this one's coming together in a different kind of way?
It's same thing. You could almost copy and paste what we set up before. Solid return for current investors. New fund sees the ability to make money. The company wants someone that will fund product innovation and strategic mergers and acquisitions. It's like a playbook. They've taken the checklist has been all checked. Let's get this deal done.
So what's interesting here for the TechTO community? What's new that you can add? Or are you just trying to show that you're a trend spotter and that you can put two like deals together?
Well, yeah, a bit of a trend spotter. We'll talk about that in the next bit here. So first of all, if fintechs were what VCs love, it seems like LMS is what PEs love. So I don't even think doubling down on the last statement. If you have $50 million revenue company or more, and you're an LMS, just come to me. I'll introduce you some PE firms. I'd like to also contrast one thing here, which is a bit different takeaway. While Waterloo and Communitech are well known and have the talent, Calgary in Alberta in general is talked about as oil and gas. It has to make the transformation, has to diversify the economy to tech. Well, you know what? This is the third large announcement of investment in, I think, the last 12 months. You had Benevity and Solimo, I think, both had large PE exits of above $1 billion. You've had Cement, who had a large round, I think it was a B round recently. Mm-hmm. So Calgary, people talk about what Calgary has to get to. It's already there. It has a diversified tech economy there. It maybe not as have the breadth or depth of Toronto, Montreal, Vancouver, but it doesn't have to. And these companies will produce other startups. So Calgary's doing better than people think it is.
And Alex, if you're in Calgary or you're in Waterloo or you're in Toronto, you can absolutely come to join one of our TechTO Together live streams. And I'm really excited for this. Tomorrow, Alex, you can discover the untold stories behind the fundraise on our very own Founders and Funding show. Who's going to be joining you at noon Eastern tomorrow, Alex?
So you got Kevin, who's a founder of Stadium Live, and he is a product guy through and through. He was first product hire at Drop. He was a product guy at Checkout 51, which had an exit and had 8 million users. Before that, he was at InVision. So, and he's passionate about basketball. So it'll be great to hear how that all played into creating Stadium Live. Then you've got Andre, who's based in San Francisco. And, because in San Francisco, everyone thinks maple syrup and maples that only come from Canada. Has a VC fund called Maple VC, and he's one of the nicest guys you'll meet. But he's an operator before, early employee at Hired, early employee at Uber. So he's seen what scale looks like. He's seen what successful scale looks like. He's seen what unsuccessful scale looks like as well. So it'll be great to hear his perspective. And it'll also be great, and I'll leave it to you to take away, which is a successful or unsuccessful scaling startup you worked at.
I have some thoughts. And then Alex, next Thursday at noon Eastern, it's our final episode of the Next in Tech mini series. Your host, Swish Goswami, will be joined by Quinn Underwood of Anemo AI to chat about the roadblocks that founders face getting started. Are you excited for this one?
I am. The mental, going back to being tenacious and persistent, you have to get rid of those mental roadblocks. Otherwise, you will not survive as a founder.
And then 8 contestants, 8 never before seen pitch decks for completely wacky and imaginary startups. What could go wrong, Alex? More like what could go right? Join us for our first ever pitch karaoke with our friends at Entrepreneur First. You'll watch the finals together with cameos from you, Alex, and maybe even me on April 29th at 7 p.m. Pretty cool, right?
Yeah.
All right. Last up for today. Pay attention to these payment players, MazumaGo and Plooto. Alex, you just want to be known as a trend spotter. You've grouped another two together. Tell us what's making news here and why you've put them together.
So first, Victoria-based payment startup MazumaGo has raised $800,000 led by angel investment fund eFund with participation from Ryan Holmes from Hootsuite. And then Toronto-based Plooto, which is also in the payments space, has raised $8 million from FinTop Capital with participation from Luge and Inovia. So why did I put them together? Two companies serving SMBs, providing payment solutions. I feel like Plooto, MazumaGo could be looked at as someone that's a couple years behind Plooto, serving the same customer base and taking a similar approach.
Got it. And of course, TechTO listeners will remember Hamid, the co-founder and CEO of Plooto, presenting about bridging the blockchain gap at TechTO FinTech in 2017. So you think they're both payment players, one's a little bit behind the other, both are making a raise this week. What's the takeaway here for the TechTO community, Alex?
So again, probably break them down a bit more. But so again, FinTech companies focus on payments for SMBs. Like just generally anything, any financial service focus on SMBs is potential to build. Like SMBs are poorly served, especially in Canada, from their financial institutions. Mm-hmm. So there's a lot of opportunity to build better products there. Or the question I have is, when you see an obvious solution here or obvious problem, it seems to be easy to get traction, but how do you scale up? How do you make money on this? Going back to Clearco, they're offering services and trying to get people come in. If you look at Plooto started off as basically where MazumaGo is right now. Hey, let's help you make payments. Let's help you receive payments. Can't remember what their business model is, but now they've got a suite of payments. It's a $25 per month SaaS. They have 4,500 customers. Mm-hmm. So their model seems to be evolving into, let's lock you in. Let's provide a suite of services. If you look at MazumaGo right now, they're really competing against the wire transfer. Hey, you go to do wire transfer, it's like $15-$20.
And it's a pain in the ass, Alex. Yeah. Let's also talk about that. I'd pay more to make it simpler.
So, they're making it, so MazumaGo is making it simpler and cheaper, $2 flat rate. And their focus, and they're, if you look at where they seem to want to go, they want to focus on building almost a network around that. And because there's hypothetically network effect. So my question is MazumaGo just 3 years behind Plooto and has to go involved in the same way as them? Or is there different markets here where MazumaGo focuses on certain sectors like real estate, where you have to send wires for deposits and construction, and Plooto works as an office workers, where there's a lot more back and forth and more regular, smaller checks. So I guess the takeaways, SMB finance still has to be disrupted. It's hard to make money. It's hard to scale. It's easy to get initial traction. So you have to get the traction and figure out how to grow it. And so would you invest in either of these companies, Alex? Maybe. But I don't have exposure to either one right now, and I may have had opportunities to invest in them. Got it. Okay, that's all we need to hear. Alex, amazing work this week. What a week in Canadian tech. If you haven't already, we need you to like and subscribe to TechTO wherever you're watching or listening, so we can keep you in the loop on what's happening in the Canadian technology ecosystem. We will see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea. So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.